Okay, welcome everybody, and thank you for joining us today for our session where we're looking at how family investment companies might form part of a family's long-term wealth management plans. Please be aware we are recording the session today, so if you miss any of your favourite parts, you can go back and see them later. Or of course, you can share the video later with other interested parties who was not able to join us today. Please do note there's a Q&A function in the bottom right-hand corner of your screen where you can send your questions over to all the participants and the panelists. And what we'll try and do at the end, if we have time, is to answer as many of those as possible. Of course, if we don't get to answer your question, just reach out to any of the panelists directly and we'll be happy to answer them there. So, what are we going to go through today? We're going to start off by just introducing how a family investment company might be used for a family's planning. We're going to review the potential structure in a family investment company and the tax consequences that might go with that, and try and bring that to life for you, looking at a case study which gives a practical example of how a family investment company can be used as part of a holistic financial plan. We're going to top that off with a look at some long-term investment considerations that a family might want to have in their investment strategy. Our speakers today are myself and Erez from Partners Wealth Management, Robert and Jamie from the Tax Advisory Partnership, and Ula and Caroline from UBS Wealth Management. So, to get us started and to set the scene, why are we talking about family investment companies? So at Partners Wealth Management, we are independent financial advisors with a focus on providing holistic financial planning. We advise clients on over £2.5 billion worth of assets and use our investment independence to help identify the best investment solutions to meet their personal financial plans. Whilst advising clients, we will often partner with other professionals, much like we're doing today, in order to give the clients the well-rounded advice that they need. We will be advising on making efficiencies whilst an individual is earning, optimising their position whilst they're investing, and also structuring the assets to help the families meet their long-term goals. Where a family has an objective to pass wealth on to future generations, this is where a family investment company might be a useful structure, alongside, of course, their broader financial planning. Because of the flexibilities within a family investment company, it can be tailored somewhat to meet each individual family's needs. Often objectives that we come across might include passing wealth on from generation to generation, but also maintaining oversight and guidance of that asset, perhaps at the senior generational level. There might be opportunities to co-invest across family members, and of course the ability further down the line for individuals to access those funds in a way that's best suited for them. Advising of the use of a family investment company as part of a family's financial plan is certainly one of the areas where we would recommend a client engages a team of advisors. And so I will now hand over to the Tax Advisory Partnership to provide us with some details on the family investment company and the tax considerations.
Thank you very much, Nathan. My name is Robert Astley and I'm a partner at Tax Advisory Partnership, or TAP for short, where I head up the Family Office Services team. I'll shortly introduce you to my colleague, Jamie Favell, who heads up our private client tax team, to talk in detail about family investment companies, or FICs for short. Before doing so, I'll give you a brief overview of TAP itself. We were established in 2010 to offer quality tax compliance and advisory services to a small but pre-existing client base here in London. We're now a multi-million-pound business across three main service lines: UK, US, and international tax, operating from offices in London and Leeds, where we have 35 staff. Our partner-led approach goes beyond simply being our client's tax advisor, as evidenced by the recent establishment of our fourth service line, the Family Office Services team, where yours truly helps new and existing clients and their trusted advisors to, amongst other things, acquire real estate assets, luxury assets, to manage their large-scale projects, and to establish global asset holding structures, for example, family investment companies. So without further ado, I shall hand over to my colleague Jamie Favell to see if FICs really are a quick fix to managing the family's wealth.
Thank you, Rob, and thank you everyone for joining us for today's presentation on family investment companies. As Nathan explained, FICs are a useful tool to manage family wealth in a tax efficient way. If a FIC is being considered by you or your clients, then it's important that this is considered as part of a complete wealth and tax planning exercise. And later on in our seminar, Erez from Partners Wealth will talk us through a financial planning case study, which considers that process in detail and outlines how a FIC can be used to achieve a client's financial goals. I'll now try and condense why FICs are a useful planning tool into a 10-minute presentation. And this is a really big topic, so please bear in mind any omissions or lack of detail are deliberate, I promise. So focusing on planning, FICs are popular because they allow family to mitigate tax exposure to personal tax liabilities and to access lower corporation tax rates. At present, FICs don't suffer the restriction on mortgage interest relief and have therefore become popular with private landlords. And typically companies don't pay corporation tax on most dividend income received, as opposed to 38.1% for higher earning individuals. So where clients are invested for income, this is a huge benefit. A FIC allows family principals to divest the value of their estate and give away assets to other family members tax efficiently, but at the same time allowing the principal to retain some control over the assets, as opposed to a trust, for example, where control of the assets is given over to trustees. And finally, FICs are outside of the relevant property regime that applies to trusts, so that the family don't need to be concerned with the various tax complications that might apply with a trust, which can sometimes be a little overwhelming, I would say. A FIC will typically be structured as a UK limited company. It's managed by its directors, who are in turn governed by a bespoke set of articles and a shareholders agreement, which when combined set out who has the control, who has the voting rights in the company, and who has a right to income. As I'll demonstrate in the example that we run through, the family principal might have a class of share which has voting rights and allows him to control the company, but not have a right to receive any income. Other family members might have individual classes of alphabet shares. These will have a right to receive income perhaps, but no voting rights. With careful drafting, the objectives of the family should be achievable, and you would expect the FIC arrangement to be able to benefit at least 3 generations of family members. We'll now focus on those main advantages of a FIC. For income tax purposes, income tax is deferred until a distribution from the FIC. So this avoids immediate tax exposure from personal tax rates for the individual, perhaps up to 38% on dividend income, 45% on other income, which is a huge benefit, of course. Salaries can be paid to the family that are directors or employees of the company, and this might be form part of a planning exercise to utilise their tax-free personal allowances. If the FIC is established with a loan from the founder, which is quite common, this allows the founder to draw down on that loan from time to time in a tax-efficient environment, and avoiding the need for income to be paid to him from the company. For corporation tax purposes, currently corporation tax is only 19%, although it is increasing to 25% in a few years' time. As I mentioned already, most dividends are exempt from corporation tax. If capital gains are realised by the company, then they'll be subject to corporation tax rates. Unlike an individual and investments they might hold, FIC expenses are usually fully tax deductible, so asset manager fees, mortgage interest paid, etc. And this lower tax means that the compound effects over time will increase investment returns for the family. And then finally, with regards to inheritance tax, the planning does provide an opportunity for the family principal to divest the value of their estate by gifting shares to family members. The gift of shares is a potentially exempt transfer, which means the 7-year rule applies. And 7 years post that gift, that it's entirely outside the inheritance tax regime. And as I mentioned earlier, because we're not using a trust with this planning, the relevant property regime that applies to trusts is entirely irrelevant. Other considerations to think about with a FIC from a compliance perspective, the directors of the company clearly have a duty to manage it properly. They must comply with Companies House and the HMRC filing obligations, payment of taxes, etc. Now, the accounts and other records that are filed with Companies House are available to view in the public domain, of course. So if your clients, or your clients, want to retain privacy, then perhaps they could consider using an unlimited private company. This would have the same corporation tax regime as a UK limited company, but not the reporting obligations to Companies House. Non-DOMs, a non-DOM claiming the remittance basis of taxation might want to structure this all offshore. There are various issues to think about here, such as management and control of the company. This is in the UK, then the UK corporation tax would still be payable, but perhaps there'd be an added layer of privacy, at least for the family. And there's also anti-avoidance legislation to bear in mind, most notably the transfer of assets abroad regime and attribution of gains. So advice would need to be taken around those issues at the right time. And then finally, with regards to family trust, some families are keen to earmark shares in a FIC for minor children or perhaps future generations of children, and it's possible to do this by settling shares into a trust. We'll now look at a case study which considers the life cycle of a FIC, looking at its establishment, accumulation and distribution phases. Firstly, in the establishment phase, so we have a founder here in our example, and he's settled £2 million of cash into the FIC. In exchange, our founders received a loan note, and the founder's lawyers have carefully drafted the company's constitutional documents, and the founder holds what we refer to as the golden share class, and further classes of alphabet shares have been created, which just have a right to income. There are no IHT considerations at this stage, but it's worth bearing in mind that if assets are settled into the FIC rather than cash, shares or a property portfolio, for example, then it would be necessary to consider capital gains tax, stamp duty, land tax, and ATED implications as appropriate. Now thinking about the accumulation phase, in our example, the company is now invested and the founder has gifted some shares to his children. At this stage, the shares gifted to the kids may have little value, but regardless, the gift of the shares will be a potentially exempt transfer for inheritance tax purposes, and the 7-year rule will apply, as I mentioned earlier. If the company receives income, realises gains, clearly they'll be subject to corporation tax as appropriate. And if the FIC owns property or invests in property, it's important that the property is let to unconnected parties and that ATED returns and obligations are met to claim relief from the ATED charges which would otherwise apply. And now we're in the distribution phase of the FIC's life cycle. So the FIC started to generate a return on its investments. It's got accumulated reserves. The founder can now consider distributing income and paying salaries as he sees fit. Depending on the children's situation, this might come at a time when it's useful to use the family members' tax-free personal allowance, perhaps the 2K dividend allowance, or to utilise their basic rate tax bands. Perhaps this also coincides with them starting university and will help to fund their costs during that time. The founder might also need to access some capital, and if the FIC has been structured with a loan, then he could repay some of that loan if he needs to access funds. Once this structure is in place, it can carry on in this way for many years to come. But if the company's come to the end of its useful life and is no longer required, then it could be liquidated. And at that stage, it would be possible for the family to access capital gains tax rates rather than income tax rates that would apply to distribution of income or capital. And then moving on now, this is the kind of the overall structure of the FIC that our founder in our example has created. We can see that the founder's investment in the FIC has been placed with a suitable asset manager, and the founder, his children, and advisors were directors of the company. The founder held a voting share class with no right to income, and the children had held alphabet shares, which allowed them to receive distributions of income and capital from the company. Obviously, as they were directors of the company, they could be paid a salary too. Moving on now, the purpose of this final slide really is to demonstrate that there's little or no restriction on the type of investments a company can hold. Certain investments will have a slightly different corporation tax position, and we can consider that separately in detail if anyone wants to get in touch. The main points to get across are: don't forget, dividends can be received tax-free. And there's no restriction on mortgage interest relief in the company. That's it from me on family investment companies for now. Thanks for listening. I hope you found the presentation useful. I'd be happy to arrange any follow-up meetings to discuss further, so please just get in touch. Otherwise, for now, I will pass you over to Erez of Partners Wealth. Thank you.
Thank you very much, Jamie. Good afternoon, everybody. My name is Erez Elbaum. I'm from Partners Wealth Management. I will be talking about a case study today, which is an attempt to bring to life a little bit of what Jamie was just discussing in terms of inheritance tax planning for somebody who uses a family investment company. The case in this example is of a person called James Smith. He'd like to set aside approximately £2 million for his children as part of his estate planning. The reason he'd like to do that is because he'd like to minimize the value of his estate on death and to make sure that it is as low as possible for inheritance tax purposes. There are two ways of doing that. One is to make a direct gift to his children, and the other is, as Jamie described, to lend the money to a family investment company, which would then use it for investment purposes. His main issues in doing this are effectively twofold. One is, can he afford to do so without drawing on his pension, which he wishes to avoid? The reason he'd like to avoid that is that a pension is a great inheritance tax tool to enable assets to be passed to the next generation without inheritance tax. So he'd like to be able to keep his pension intact to the extent possible. There's another reason, and that is by drawing on a pension, you end up paying income tax on the drawings, and that's something that he'd like to avoid as well. His second concern is that gifting a large sum absolutely to his children means that he loses control over that money and the ongoing management of the investments. And he may not then have enough to cover his ongoing expenses. So let me tell you a little bit about James. He is currently 55 years old. He has a planned retirement age of 60. He currently earns approximately £400,000 per annum and has expenditure at a similar level. We calculate that at the age of 75, at approximately 4% growth per annum, and with inflation taken into account, his estate will grow to be approximately 8.4 million by the age of 75. After we consider excluded assets in the nil rate band of 325,000, his taxable estate would be worth approximately 6.3 million, leaving a tax bill of 2.5 million, and so net assets to the children of approximately 5.9 million. Now we can see this depicted in this diagram in two ways. The first is that at the top of the diagram you see a cash flow analysis, and at the bottom of the diagram you see an asset analysis. So just very quickly, in terms of what he currently earns, it's approximately £400,000 per annum, growing at a rate of inflation. His expenses represented by the black line, approximately 400,000. Those both drop down, so his earnings will drop down to approximately 200,000 because he'll be using the lighter blue columns, which is his savings and investments, to pay his expenses, which will also be correspondingly lower because he'll have lower tax to pay and he will be contributing less to his investment structures. In terms of assets, he starts with approximately £5.5 million of assets at the outset at the age of 55, which is now, and he ends up at the age of 75 using growth, as I say, of about 4% per annum and inflation of approximately 8.5 million by the time he's 75. And just to explain what these various stratas are, it's the illiquid asset of his house, which is the purple one, approximately £1 million, his general investment account, which is his sort of unwrapped assets, that represented by the blue columns, starting at approximately £3.5 million, and then his pension, which starts at about £600,000 and goes to about 1.5 million by the time he is 75. Now let's look at the situation where he makes a £2 million gift immediately to his children, and of course loses control over that. That is subject to the potentially exempt transfer rules, which mean that he has to wait 7 years to make sure that that is effectively absolutely out of his estate. If he dies within the 7 years, all or part of it will be added back to his estate. What this shows is that in the purple below, you see his house grows at the rate of inflation. That's his illiquid assets. The blue is his general investment asset, which diminished to approximately 0 by the time he's 75, and his pension remains intact and grows, but is the last remaining liquid asset that he has available to draw on. And that's something that he doesn't want, because he wants to preserve his assets, his pension, for the purpose of passing to the next generation, effectively inheritance tax-free. So this is the situation. So we can see from this diagram that he has the ability to make the £2 million gift. The question is, how is it best that he do this? So instead of gifting the money absolutely, he has the option of lending it to a family investment company, which company will then use that to make investments. By doing this, he effectively excludes all of the future growth on that money from his estate, whilst maintaining access to the loan capital. The way he accesses the loan capital is that loan is repaid, that £2 million loan is repaid by the FIC over the course of 15 years at £133,000 per annum. This gives him the ability on an ongoing basis to meet his expenses, which, if you remember, was one of his initial concerns in whether this was a good idea from an absolute gift perspective. So it allows him to do that because he's repaid at £133,000 per annum. At 75, this shows that his net worth is approximately 6.5 million, which excludes the FIC, which at that point would have a value of approximately 2.25 million, using the growth parameters we mentioned earlier. So after excluded assets in the nil rate band, his taxable estate is 4.4 million, leaving a 1.7 million pound tax bill and net assets of 4.7 million pounds. Adding the FIC to that, which is worth approximately 2.25 million, you'll see that the overall net estate left to the beneficiaries is approximately 7 million, as opposed to the previous roughly 6 million. So a position of £1 million more than doing nothing and not removing this 2 million from his estate. So at least from an inheritance tax point of view, it's obvious that this is a good option for him to utilize. But more importantly, I mean, had he gifted the assets instead of putting them or lending them to a family investment company, it would have had the same result on the overall value of his net estate. But he would have, but it would have had two consequences. One is that he would have lost control over the assets and not being secure in the knowledge that he could cover his ongoing expenses. And it would have also left him with the position that he may have had to draw on his pension, something that he didn't want to do and wanted to leave effectively that pension whole to pass to the next generation, effectively inheritance tax free. But most importantly, even leaving aside the inheritance tax considerations, what this allowed him to do was effectively have options. For example, he could have chosen to forego the loan repayments and leave additional money inside the family investment company, which would then again be passed effectively tax-free to the recipients or the shareholders in the family investment company. He's chosen, as you can see from the contents of this diagram below, to start other investments, which are represented by the dark green. So he can contribute to other tax efficient wrappers, like an ISA in this case, which he has started to contribute to with the excess capital that he had as a result of the loan repayments being made from the FIC. So rather than making the gift absolutely, he was enabled to continue to receive cash, which the surplus of which he could invest as he chose. And as you can see from the bottom, the light green in this graph, he also retains his pension intact, which is a vehicle that he can use to pass inheritance tax free to the next generation, and also doesn't have to draw on the pension, which involves a tax implication in terms of his drawings will attract income tax. So really, this is about choices, and it's about him being left with options as to how he structures his planning. And it's just that the family investment company gives him the additional option to maximize his flexibility and his earnings and covering his expenses during the course of his lifetime. Thank you very much. If you have any questions on this, we can take them at the end. In the meantime, I'll pass over to Ula from UBS, who will talk about the contents of a family investment company and how these might be populated with underlying investments. Thank you very much.
Thank you, Aris, for this really helpful presentation or illustration of valuable outcomes that FIC can provide. Hi, I'm Ula Carotto, and I'm a client advisor at UBS, working with high net worth clients who range across entrepreneurs, executives, wealthy families, and so on. And I have a particular passion for sustainable investing. As a global wealth manager, we at UBS are able to add value that goes beyond investment management through holistic wealth management service, which incorporates wealth and financial planning advice, banking and lending, philanthropy, and more. And we amplify everything we do by realizing the global network effect of UBS. I bet you all frequently consider how important connections are in the modern world. Well, we at UBS, I think they're so important that they're part of our DNA, part of our purpose, which is reimagining the world of investing and connecting people for a better world. On that note, I would like to introduce you to Caroline Simmons. Caroline is our Chief Investment Officer for the UK. The Chief Investment Office is our independent research function for UBS Global Wealth Management. It's a global team with about 160 analysts and a combination of top-down economists and bottom-up single security analysts. I asked Caroline to talk to you today about some of the ways we can invest in FICs, for example, via private markets, and also via sustainable investing, which is our preferred approach. And so Caroline will share with you one of our sustainable investing themes with you. Caroline, over to you.
Thanks very much. Good afternoon, everyone. So yes, as Ula explained, I'm going to talk about a couple of the many potential investment approaches that you could take within a FIC, private markets and sustainable approach, and then discuss an investment theme in the sustainability space called the future of Earth. So private markets essentially are a way to consider capturing excess returns. This chart shows you our 15-year forward return expectations of different asset classes. And you can see here private equity expected returns are higher than they are for either other private markets, but also particularly the listed space. And so we do believe, particularly at this point in the cycle, that the illiquidity premium that you are paid for investing in these less liquid assets is worth it for your return profile. Also, from a longer term structural perspective, this chart shows you that the returns, the internal rate of returns for private markets are shown in the brown bars, and the returns for the listed equity market are in the beige bars. And you can see that over time, the private market nearly always provides higher returns than the listed market. And therefore, if you can tolerate some illiquidity, having some exposure in your portfolios or in your FIC could well, be a sensible thing to do with regards to generating your longer term performance. The second investment approach I wanted to discuss was about investing sustainably. Now, different people have different views on what that means. For us, sustainable investment is a set of investment strategies that incorporate the E, the S, and the G, so environmental, social, and governance considerations into the investment decisions, whilst achieving comparable market returns. And that last point is very important for us. So this is not about charity. This is not about investing in good causes and sacrificing returns as a result. This is about generating the same level of returns as in a traditional type of investment, but with a sustainability overlay. And this chart shows you in the left-hand bars the returns over a 28-year period of the S&P index in grey, the US equity market index in grey, and of its equivalent sustainability index in yellow. And you can see that the returns are very similar over a long period of time. And the two bars on the right show you those same indices, but from a volatility perspective, so the level of risk. So very, very similar returns from investing sustainably as not. So there is no sacrifice on performance on the equity side. Similarly, on the fixed income side, if you're investing in a sustainable manner, there is also no sacrifice of performance. And in fact, you can also usually achieve higher quality. So the green bond index is generally made up of slightly higher rated credit quality companies than the broader global corporate bond index. And what that means is that actually when you get periods of sell-off and sort of risk aversion, that actually in the black line you can see here, the green bond index falls less. It has a lower drawdown than the underlying corporate bond index. But that over time, the performance again is very similar between the two. So moving on to one of the sort of strategies, investment themes that we can see within particularly the sustainability space is a report we've published called The Future of Earth. And it sort of brings out some, staggering sort of facts and figures here for us. $280 billion is the annual cost of environment-related disasters. $5 trillion are the welfare losses due to health effects of air pollution in 1 year. 70% of global greenhouse emissions come from energy. $700 billion is the estimated investment opportunity in sustainable agriculture by just 2030. And $655 billion is the estimated size of the water market, the size that it was last year. So these are some pretty big areas, and where the markets are sizable, that gives us a sizable investment opportunity. So digging in a little bit further, the report looks at 4 main areas where we can look for solutions for a more sustainable planet and generate some good investment returns. The first is people, health, and communities. The second is energy. The third is land, and the fourth is water. So why is now particularly important? Regulatory change is one reason that is obviously pushing people and companies to focus on these areas. Technology is improving, allowing some of these newer areas to develop faster and in some cases more cheaply. And consumers and companies and investors are now demanding a more sustainable approach. So where can we invest? Either in technologies and solutions aimed at solving key environmental challenges, or in companies that are actively tackling the environmental risks and the opportunities within their own operations. So taking a little bit of a closer look then at some of those four categories. In terms of investing solutions for health, air pollution is the largest environmental linked threat for human health. And you can see here that it's mainly cardiovascular and lung diseases that are linked to air pollution. Extreme urban heat is also claiming lives and jobs. We can sadly see what's been happening in Canada in recent sort of days, and the death toll there from the extreme heat that they've been experiencing. And it's particularly an issue, in high density urbanized areas. Where can we invest to benefit from these trends? Well, treatments for illnesses that are linked to climate change, such as the drugs or the medical devices used in treating these medical conditions, would be one area. And also companies that are effectively addressing the health and safety of their own employees would be another. Turning to the communities, we are seeing sea levels rising, and the forecasts are for sea levels to rise by another 3/4 of a meter by the end of the sort of in the next sort of 100 years, by the end of the century. And obviously this is posing a risk in terms of flooding for either low-lying or coastal areas. But at the same time, we've also got a lot of subsidence going on. And we've shown you here some of the subsidence rates for different cities. And in many cases, the subsidence rate is occurring at a rate that is 10 times faster than that of rising sea levels. So your risk of flooding obviously is significantly higher if you're also sinking at the same time as global sea levels are rising. And some of the reasons for the subsidence are over use of groundwater in industrial processes, over excavation, excessive use of groundwater for drinking because there's no other drinking water supply. That's particularly a problem more in the emerging markets. And as a result of this, we end up with environmental migration, which can be a really big impact. And then it also has sort of secondary effects where you get sort of channels of people moving down certain ways or between certain countries, and the loads and pressures that that puts on the social systems in those areas, and also even further so on the environmental. So where do we invest and how do we look for solutions for these sorts of problems? Well, it's urban planning, it's smart city technology, and companies that are addressing their employees' working conditions and their exposure to physical climate risks. In terms of energy as our category for the impact on the future of Earth, the energy transition is probably the most widely discussed area linked to climate change, I would argue. And this chart here shows you that where the new additional power capacity is coming from, which source of energy it's coming from. And the darker bars are in the past and the paler bars are in the future. And basically you can see that historically additional energy and power capacity was predominantly provided by coal and to an extent gas. And going forward, the additional power capacity is going to be increasingly provided by solar and by wind and also by gas. So this shift in where we're going to be getting additional power from against the backdrop of increasing power needs becomes very important, particularly around the time of transition. And we need to be mindful of the sort of effects of the transition and any limitations on either capacity in the new renewable energy spaces. So, for example, I'm thinking about sort of requirements for additional limited resources, perhaps, such as lithium or cobalt, and the pressures that that puts on, and what are the environmental impacts of mining those, and also the suitability of the new energy. So it's obviously very encouraging to be able to have a lot more electric power to fuel vehicles. But for example, airplanes have not yet been designed to be able to fly on batteries. So we kind of still need the fuel if we want to be able to, the oil-based fuel, if we want to be flying airplanes for a period of time during this transition. And you know, the energy transition is such a broad-based, borderless issue that it really does require governments and policy to bring about that change. And clearly, you know, we've seen a big step forward in that sort of area with all the net carbon neutral pledges that various regions have made to reach by 2050 or 2060. So where do we invest for this sort of change? Well, it's renewable energy generation, obviously, electrification of transport, so fuel cells, batteries, alternative fuels, carbon capture, and also energy efficiency. So for those that are using oil, how are they using oil more efficiently? And companies that manage their own carbon footprint. And then turning to the land, sustainable agriculture is key to climate. The way that we use the land is pretty intensive, and particularly meat consumption is very heavy user of land. Cattle is the highest source of deforestation from the agricultural sector, and the production of beef has the greatest water intensity of all proteins. As we see rising incomes across the world, we can see from this chart that actually that usually correlates with rising meat consumption. So we need to think about more environmental ways of achieving either meat consumption or alternative protein consumption. And where we can invest, obviously, is companies that are either monitoring land use and supply chain validation, those that are investing in smart agricultural technologies, sustainable production and consumption, or those that are targeting their own carbon footprint within their own operations as well. And the last point is coming to water. You know, water obviously is a finite resource. The demands on it are increasing with increasing population and increasing standards and increasing urbanization. Stresses continue in the emerging markets, predominantly from population growth and rising incomes. And you can see that the demand for water in the future here in this chart will be driven by these sort of pale blue areas, which are predominantly Asia and Africa and emerging markets. And so how can we invest in this area? Smart water networks, water automation systems, water metering, water testing, desalination equipment, and obviously companies that are managing their own water consumption in their supply chain in a more sort of careful and economic way. So I've shared with you, you know, a couple investment approaches that you could take within a FIC. I've discussed the sort of private equity structure and also an approach of sustainable investing. And I shared with you our thoughts on some specific investment ideas around the future of Earth.
Thank you very much, Caroline. Thank you, everyone, for speaking. I think we do have a little bit of time here to take a few questions. I've got a few come through to get us started. But of course, if anybody wants to ask any questions, do type them into the Q&A box, or of course contact any of the lovely people whose faces you can now see on the screen with phone numbers and email addresses. Looking at the questions, I've got the lovely ability here to fire them off and challenge our speakers. So I'm going to start maybe with you, Jamie. You mentioned that most dividends are tax-free within a family investment company. The word "most" has got a few people questioning. What does that actually mean?
Sure. So generally dividends, whether they're received from a UK company or an overseas company, will be exempt from corporation tax, provided that the dividend is received from companies that are resident in a country that has a double tax agreement in place with the UK. They're referred to as qualifying territories, and the treaty would typically have a kind of a non-discrimination clause which ensures this exemption applies. So any country with a double tax agreement in place, and typically not any country which is considered a tax haven by the UK. Hopefully that clarifies.
Great, thank you very much, Jamie. So another question here. Perhaps this is Erez. Have a go. It looks great. Should we just stick everything in a family investment company and solve all our problems?
That's a very good question. Every part of financial planning has a role, so I suppose the answer is probably not, unless you've taken advantage of all of the other tax efficient investment structures that are available to you. But once they are maxed, I suppose, or used up, then there is scope for sort of almost an unlimited amount to be put after that into family investment companies.
Yeah, great. And you know, I suppose leading on to that, or from that, when do you typically find that clients you've worked with are interested in looking at a family investment company, or put the other way around, when would you take the idea of a family investment company to a client whilst you're doing their financial planning?
It's funny because it's kind of a circular thing. I suppose when people realize that they have surplus assets that may be subject to inheritance tax, and that they can see out their expenditure requirements through their lifetime, but will have a surplus. When they discover that, I suppose that they want options to either minimize inheritance tax or pass assets to the next generation during their lifetime in a tax efficient way. And that is when they normally come to family investment companies, assuming that they, as I said earlier, that they've used all of the other options available to them. But yes, I suppose as soon as people realize that they're self-sufficient, they have surplus assets that you know, may be left in a non-efficient inheritance tax way, then they're very keen to get involved on this in a family investment company for those reasons.
Great, thank you. One here, possibly Ula or Caroline, you mentioned you had a lovely graph there about showing how private equity investments perhaps provided higher long-term returns than standard equity markets. How much of a portfolio would you typically be recommending a family allocate towards such investments?
Yeah, it's a good question. It depends a little bit on the time frame that you have and the ability, obviously, to tolerate the illiquidness of private equity. But if you had a long time frame, then in theory you could have up to about 40% of your portfolio in private markets, and within that you would have up to 20% in private equity. And that's actually in line with what we're seeing. Quite a lot of the sort of institutional sort of endowment managers and things have been increasing their allocations, and we think 20% probably where you'd want to head to with a very long time frame.
Thank you. A question here that perhaps Robert, if you're still able to hear us, perhaps a question for you. What kind of scale of assets do you typically see people kind of starting to look at putting into a family investment company? And I'll ask you a connected question to that, which perhaps kind of helps think about it, is when setting up said investment companies, do you usually just have individual directors, or would you also be appointing some professional directors to these companies?
Answering the second one first, I would recommend having a professional director as well as members of the family. So in the slide Jamie showed, there was trusted advisors, which could be the lawyer or the accountant or the banker or the wealth manager, or indeed those of a fiduciary provider or corporate service provider in the UK, perhaps as company secretary, because it is quite unique running a UK company if clients aren't used to it, and the intricacies of taking minutes and keeping all the books and records straight, and the filing obligations, which of course the accountants and tax advisors can do. As for scale, I mean, you wouldn't really want to set up a family investment company for anything under sort of 2 million. It'll depend what the client's funding the structure with. We've used cash in our example because that's easy. There's less complications with pregnant gains if you're settling assets in. The investment criteria that can go into a family investment company is unlimited, really. So we see clients who just use them as vehicles for their property investments, but typically, you know, a 2 million plus discretionary portfolio would be typical.
Yeah, and I think Aries, maybe you can comment on this as well. Does that kind of chime with the types of levels that you typically see clients starting to have family investment companies?
Yes, I think that's absolutely right. I think, I mean, as I said earlier as well, I think there, you know, once you have optimized everything from a pensions, ISAs, and potentially offshore bonds and other you know, tax efficient vehicles, then I suppose the starting point to make it efficient is probably about £2 million. But then, as I mentioned, probably you know, the sky's the limit. The issue really is, you know, administrative costs and you know, what is the worthwhile level to, you know, make those, I suppose, relatively negligible when looking at the overall picture.
Thanks. Question here, but back to you, Jamie, if I can. You touched on this in your presentation, and Robert just touched on it a little bit there. Transferring cash into the portfolio, nice and simple. Transferring assets into a portfolio, that's not quite as straightforward, is it?
No, that's right. You do need to consider whether or not the assets being transferred are pregnant with gains, as Rob mentioned, so you would potentially crystallize the gains on transferring the assets into the company, because it is a separate person for tax purposes, so there is a disposal there. We'll often look at a client's portfolio and perhaps only transferring assets which aren't going to trigger a capital gains tax charge. We've done that with investment portfolios and also property portfolios, and kept the ones which would trigger big liabilities outside of the FIC. There are SDLT considerations if you're transferring property into a family investment company, and typically we're probably all aware that there's a 3% SDLT surcharge where you're purchasing additional properties, and that 3% surcharge would always apply to a transfer of a residential property into a company. There are various planning opportunities which can be considered to mitigate those the exposure for SDLT and gains on property when they're transferred into the company. But that's probably a different topic for this. Yeah.
A bit of a follow-up question, Jamie. We've mentioned in the examples the principal making a loan to fund the company. Is that okay? Has HMRC got any view on that, or what thoughts do you have on that?
Yeah, it's entirely fine. We have to be mindful and advise clients around legislation which is known as transaction in securities. So we do need to be mindful that kind of regular drawdown on the loan isn't taken, which might look like a dividend or some other extraction of profit from the company. So I would say the repayment of the loan should be fairly irregular to avoid those issues. Are they something which come up in practice? Not so much, but it is a consideration. Otherwise, the loan should be fine. I've got no concerns around that.
Great. Okay, I've got another question here, which perhaps we'll use as our final question, and I've saved it to the end for Caroline. Caroline, can you give us just a quick overview on where you think markets are going at the moment? I think a lot of people have kind of got the question mark over low interest rates. Does that mean low returns? We're going to ask you to squeeze it to 2 minutes.
Sure. So we are positive on risk assets, and we see, for example, in the equity markets, about a 5 to 10% further upside from here by the year end, and some additional upside next year. We believe that the strong market performance that we have seen is actually only keeping pace with the strong profit growth that companies are experiencing in the bounce back from the recession due to the pandemic last year.
Thank you very much. Well, everybody, if we didn't get to your question, please do contact any of us directly, and we'll be happy to speak with you. Otherwise, we'll bring this webinar to a close, and thank you all very much for attending.
Thanks. Thank you, Nathan.
Bye, everyone.